Welcome back to Talk Tickers. It is Sunday, February 8th, 2026. And yeah, for anyone looking at their calendar, a little confused.
Right. We don't usually do weekend.
Exactly. But if you have been refreshing your terminal or watching the tape, you know exactly why we are here today. We are breaking down the big one, the Take-Two Interactive Fiscal Q3 2026 print.
The entire industry and probably half the population under 40 has been holding its breath for.
And let's be honest, going into this, the vibes were, well, they were not great. There was some serious jitters in the air.
Oh, for sure.
I was looking at the options chain on Friday, and the put buying was heavy. I'm talking activity up something like 135% versus typical volume.
The bears were definitely out. They were betting on a disaster. The sentiment was incredibly heavy.
But if you look at the aftermarket action, those bears are probably scrambling to cover right now.
They absolutely are. The stock closed the regular session around 212, but the second those numbers hit, it just ripped.
Ripped is the right word. We saw a trade up over 5% in extended trading, pushing right through that 223 level.
A violent snapback.
It was. But before we get into the percentages and all that, we have to talk about the narrative. Because for the last 2 years, investing in Take-Two felt like a waiting game. It was all so nebulous.
It was waiting for Godot.
Right. You knew the catalyst Grand Theft Auto Betas was out there somewhere in the ether. You didn't know when. It was always fiscal year something something.
And now we have a date.
A specific date. Circled in red, permanent marker on the calendar.
November 19th, 2026. That is the line in the sand. And that changes everything because now the market can actually build a model that ends in a concrete event, not a giant question mark.
We're going to spend a lot of time on that date. A lot. But first, we have to eat our vegetables. We need to look at the core business.
Right.
Because having a huge launch is great, but you still have to pay the bills until then.
So, how did the core business actually perform this quarter? If you want the headline financials, I can give them to you, sort of hedge fund style. Because honestly, this was a clean sweep.
Okay, hit me with the numbers.
Net bookings came in at $1.76 billion.
Wow. And the street was looking for what, 1.59?
159, yeah. And management's own high-end guidance was only 1.6 billion. They just blew past it.
And for listeners who might get tripped up here, why do we focus on net bookings instead of just revenue for a company like this?
It's a great question. Net bookings essentially captures the digital sales and virtual currencies sold today. Standard accounting revenue might defer that. So bookings is really the cash register ringing right now.
And that cash register rang how much louder?
28% louder than it did last year, a plus 28% jump.
Okay, so top line growth is absolutely real. What about the bottom line?
Adjusted EPS came in at $1.23. Consensus was sitting at just 83 cents.
So they crushed the bottom line by 40 cents a share.
They did. But here's the metric that really matters for the long-term thesis, and I want everyone to pay attention to this. Recurrent consumer spending, or RCS.
The sticky money.
Exactly. Virtual currency, battle passes, all the microtransactions. That was up 23% year over year.
And what percentage of the total is that now?
It now makes up 76% of their total bookings.
That's staggering. 3/4 of their business is from people already in the ecosystem just spending more money. That's a recurring revenue model.
It is. And because that machine is working so well, they didn't just pat themselves on the back. They actually raised the outlook for the rest of the fiscal year.
Which is pretty rare. Usually companies try to sandbag a bit, lower expectations.
Not here. They are lifting the full fiscal year 2026 outlook. They now expect net bookings between $6.65 billion and $6.70 billion.
Okay.
And maybe more importantly, for the valuation models, they bumped their operating cash flow expectations to roughly $450 million. That is up from their prior view of $250 million.
That's nearly doubling the cash flow expectation. I mean, that's real cash.
Correct. And when you look at the language in the transcript, the tone is just different. They use phrases like across the board outperformance.
And what about costs? Were they just spending a ton to get that growth?
That's the best part. Operating expenses only rose about 10 to 13%, depending on how you measure it.
So they're growing revenue at 28%, but expenses only at, what, 10%?
That is the definition of operating leverage. They're controlling costs while the top line just explodes.
Okay, so they're making more money, they're spending it more efficiently, the cash is piling up. That sets the stage perfectly for the elephant in the room. Let's pivot to Grand Theft Auto VI.
The catalyst of catalysts.
We mentioned the date, November 19, 2026. That puts the launch squarely in fiscal year 2027. But I noticed something interesting in the transcript about the marketing rollout.
Yeah, that stood out to me too.
It feels like we've been in a vacuum of information, right? A trailer here, leak there, but now they're saying, get ready.
Right. Management explicitly stated that Rockstar's marketing blitz begins this summer. So we are just a few months away from the hype cycle truly kicking in.
But what I found fascinating wasn't just the date. It's how the CFO framed the financial impact after the launch.
Oh, the baseline comment.
Exactly, the baseline comment. What does that signal to you?
Usually with a big game, you model a massive spike, a mountain peak, and then a sharp drop-off.
Sure, you sell the boxes and then it trickles down.
But management explicitly called fiscal year 2027 a new financial baseline for the company.
Baseline is a heavy word. That implies they don't expect the numbers to go back down.
Precisely. They view the release of GTA VI as resetting the floor of their earnings power, permanently higher.
But I have to play devil's advocate here for a second. Is that realistic? Can a single game really do that? Or is that just CEO optimism?
That's the right question. But the proof is in the pudding with Grand Theft Auto V. That game came out in 2013.
3 presidents ago.
Yeah. And it has now sold 225 million units. But here's the data point that just blew my mind this quarter. You would think a 12-year-old game would be dying off right.
Right, you save your money for the new one.
Wrong. The Safe House in the Hills update for GTA Online actually drove a 27% increase in recurrent spending for the franchise this quarter.
Wait. Recurrent spending went up 27% on the old game?
Yes, and that proves the bull case. The user base isn't shrinking, it's growing. They are engaged, they are hungry. The GTA Plus membership, their subscription service, it nearly doubled.
That changes the risk profile significantly. They aren't launching into a cold market. They're launching into a furnace that is already burning hot.
That's a great way to put it. The ecosystem is primed.
However, GTA isn't the only engine here. And this is where I think people get tunnel vision. We have to talk about the quiet giants funding this whole thing. Let's talk about NBA 2K.
NBA 2K26 performance was described as stellar. They've sold in 8 million units already.
And sold in means to retailers, right? Not necessarily to customers yet.
Correct, into the channel. But look at the engagement metrics. Recurrent consumer spending, daily active users, and My Career users were all up 30% year over year.
30% growth on an annual sports title is just, it's unheard of. How are they doing that?
It speaks to the maniacal attention to detail that Strauss Zelnick, the CEO, mentioned. They aren't just updating rosters, they are refining the whole social experience.
So you log in to shoot hoops, but you stay to hang out in the virtual city.
Exactly. And speaking of social, we have to talk about mobile, Zynga. I feel like this gets overlooked, but mobile is roughly 46% of the entire business.
It's nearly half the company.
And mobile net bookings grew 19%. This is in a mobile market where, well, a lot of competitors are actually seeing declines.
So what's driving that? Is it just new games?
No, and that's the thing. It's actually the legacy titles, which makes it even more impressive. Toon Blast is an 8-year-old game, and it grew 43%.
43% for an 8-year-old mobile game.
Yeah. Match Factory up 17%. It's what Zelnick calls bold beats updates that refresh these older games and make them feel new.
So it's the same strategy as GTA V. Keep the old stuff fresh. I also saw ad revenue was up 10%.
That's a key part of the strategy, monetizing the non-payers. In mobile, you have 80% or more of users who never buy a single thing.
Right.
So by integrating non-intrusive ads, Take-Two is capturing value from that huge segment without ruining the experience for them.
And what about this direct-to-consumer push, the DTC thing? Why does that matter?
It matters for margins. Think about it. When you buy something through the App Store, Apple takes a 30% cut. The Apple tax.
Sure.
If Take-Two can get you to buy through their own web store, they keep that 30%. Management said this is becoming meaningful for margins. It's basically free money.
Okay, so the cash cows are printing, GTA VI is locked in. But we have to address the bear case, because going into this, the stock was down 18% over 3 months. And the fear wasn't about games, it was about AI.
Specifically, generative AI. Google showed off Genie, and the market panicked. The narrative was, why do we need Rockstar if AI can just generate a game?
The classic disruption fear.
Mm-hmm.
So how did management handle this? Because I read the transcript, and Zelnick seemed almost confused by the question.
He was. His rebuttal was essentially, guys, video games are math. They are AI. We've been using this stuff for decades.
I loved his pushback where he said these early AI models are not in the same ballpark as a full game engine.
That's the crucial distinction. AI can generate pixels. It can make a video that looks like a game. But Zelnick argued it can't generate mission structure, storyline, emotional connection, or vibe.
Vibe is hard to code.
Exactly. You can have AI build a city, but can it make you care about the character in it? Management's stance is that AI is a tool for efficiency. It does the mundane tasks so creators can focus on the red meat.
Red meat, I like that quote. It implies the human element is the premium product.
It's a very aggressive way of saying, we use tools to make our artists better, not replace them. The argument is that premium, handcrafted experiences actually become more valuable in a world flooded with mediocre AI content.
So the moat isn't the engine, it's the soul of the game.
Precisely. And judging by the stock reaction, the market bought that defense, at least for now.
Which brings us to investor context. We mentioned the stock was down 18%, lagging the SPY significantly.
And that lag explains the violence of that 5% snapback. The market had priced in an AI disruption discount and an execution risk discount. Both of those fears were put to bed on the call.
So the stock had to re-rate immediately.
Yep.
And now they're sitting on this raised cash flow guidance, $450 million. What are they going to do with all that money?
Management laid out 3 priorities. First, organic growth. Second, selective M&A. But Zelnick emphasized they are very picky.
And the third?
Shareholder returns.
Buybacks. I have to mention Zelnick's little humble brag about their last buyback.
It was a classic CEO flex. He reminded everyone they executed their last big buyback at around $158 a share.
Right.
And now, with the stock over $220, that looks like a genius move. He's basically signaling, we know when our stock is cheap, better than you do.
That is a powerful message to send right before the biggest launch in history.
It is confidence, pure and simple.
Okay, we've covered the beat, the date, the AI defense, the cash pile. Now, let's get to the part everyone waits for. We take off the analyst hats, put on the trader hats.
The fun part.
It is time for our This Is Not Financial Advice segment. I want the outrageous but plausible trade based on everything we just heard.
Yeah.
What's the play?
All right, strictly for entertainment purposes, and seriously, don't try this at home.
Right.
Here's the pitch. I'm calling this the summer marketing calendar spread.
Okay, I'm intrigued. Walk me through it.
So the setup is this. Management explicitly said the marketing blitz begins this summer. The launch is November 19th. The hype cycle hasn't even started yet. We are in the calm before the storm.
Right. And the AI fear is still lingering out there a bit.
It's evaporating, but it's there. So here's the trade. You go long the November 2026 calls. You want to own that launch date.
But options that far out are expensive.
They are. So you finance it by selling short-dated puts against the AI fear narrative.
Okay, explain that for the non-options people.
You are selling insurance to the bears. You're betting that Google's genie won't destroy the Take-Two moat in the next 3 to 6 months. You collect the premium from them to pay for your ticket to the GTA launch party.
So you're funding the upside by feeding the panic.
Exactly. And here is the outrageous kicker.
Let's hear it.
I'm betting that the new baseline comment means that when they give official FY27 guidance in May, the numbers will be so staggering that the stock attempts a run at the $300 analyst targets before a single copy of GTA Zero Eyes is even sold.
A run to 300 on pure guidance. I love it.
The trade is really a bet on that May guidance call. The summer marketing is just the cover story.
And just a reminder to our listeners, that is absolutely not financial advice. We're just exploring how the smart money might look at this. Please do your own due diligence.
Always. But the setup is certainly there.
It really is. So let's wrap this up. What is the one thing the listener needs to take away from this print?
It's simple. A massive beat, a raised guide, and a concrete date for what is probably the biggest entertainment product in history. The uncertainty is gone. Now it's just about execution.
And as we know, execution is what this team does. They eat red meat for breakfast, apparently.
The story stock debate is alive and well, but for now, the bulls absolutely have the wheel.
They certainly do. That is it for this deep dive into the Take-Two Interactive earnings. If you enjoyed this breakdown, make sure you are subscribed to Talk Tickers so you don't miss the next print. We'll be watching that November 19th date very closely. Thanks for listening.
See you next time.